Welcome everybody to our webinar this morning on Thursday, October 9th. I can see that a good handful of people are already hopping in here for our webinar. So we'll give it another couple of seconds and then get started. But just as an intro of kind of what we're talking about today, we're going to be going over the annuity. We call it the annuity trap. It was a topic that we did for one of our fall seminar series, and we've had a couple of conversations and just thought it'd be a good conversation for people to understand the risks, the red flags, and other options when it comes to annuities. There's a lot of unknown about them, and so wanting to put that out there. And so if you have any questions throughout the presentation, feel free to use the Q&A portion of the chat. Throw questions in there. Happy to talk through them, and as always, it's going to be recorded and put on to our website afterwards. So if you want to review it, share it with somebody else, want to watch it later, or have to hop out early, something like that, we're happy to you can take a look at it there. So with that being said, we'll hop right in to the presentation. So we thought it'd be smart, and apologies for Ben. He's unable to make it on this webinar today. So DJ will be handling it. Forgot to introduce myself. Most of you probably know me by now, but anyways, I thought we'd start with talking about what an annuity is. We'll later on in the presentation, we'll go through a couple of different of the basic types of annuities, although there's a lot of variables that come into the different types and the add-ons to the annuities and whatnot. But at its simplest form, an annuity is a financial contract sold by an insurance company. So they are agreeing to a certain rate of return, and they're offering that to a client, an individual. And then there are a lot of added things that can be put into it. But at its basic core, that's what it is. It's a contract between an individual and an insurance company, and that they agree upon a certain rate of return or a certain set of conditions, and the individual will then give money to the insurance company. And so in annuities, although they do get a bad rap, and you may pick up on that from even this presentation of things that we've seen that have hurt people with annuities. Inherently there's nothing wrong with them. There's nothing illegal. There's nothing bad. It's more about people getting into situations with annuities that are not meant for them, and that end up hurting their situation or don't give them the benefit that it could, right? But there are many times where an annuity might make sense, if you treat it, in certain ways. So the purpose of an annuity for most people is going to be to provide income. Sometimes it's immediately, putting money in and guaranteeing a certain rate of, monthly distributions or something like that for the rest of your life. That's a version that can happen, or in the future, whether it's a payout later on, or just making money and growing along the way, and then you get money at the whatever that looks like, right? But the purpose is income. It's growth. It's growing the money in some cases, income in others, either now or in the future. So commonly, annuity it's a safe, guaranteed growth. There's a lot of those, words thrown around with annuities, and they can do that because it's backed by an insurance company. It is an insurance, a fixed annuity is an insurance product. You have variable annuities, and we'll go into those in a minute, but that are more of the investment side of things, and so there's some guarantees there, but at its root, an annuity, it's marketed that way because it's you're agreeing to a certain rate of return, agreeing to a certain income stream, so there is some guarantee there that the insurance company has to hold up their end of the bargain of what they promise that they're going to give you. And then they're typically purchased either lump sum. So you might have, often people may put retirement savings into an annuity, whether in the 401k or outside the 401k, or it could be a series of payments that those can happen as well with the variable annuities, that you make payments over a certain set of years. So can be either or, doesn't always have to be, a lump sum. They can come in a lot of different forms there. So why annuities are commonly pushed? If you're on this call, and or you may, anybody that's listening to this probably knows of somebody, a family member, a friend, yourselves, that has either had a bad experience with an annuity in the past or is invited to a, financial advisor steak dinner, to pitch how they can help you grow their money. And often annuities are included in that. They're commonly pushed. And a few of the things that I wanted to bring up here, and the reasons they're pushed is because typically with annuities, they're dealt on commission. And, it's a good, easy sales pitch, right? Everybody loves to hear safe, guaranteed income, right? We're gonna grow, or safe growth. You're not gonna lose any money. So it plays to a lot of fears that people may have about the market. But the top one there that I have is that advisors are often not fiduciaries. So what that means is, if you're not familiar with the term fiduciary, is that a fiduciary is required by law and to act in the best interest of the client with their recommendations and whatever we do. And so at Navigate Financial, we are fiduciaries when we offer advice. When you're selling an annuity, it's not always required that that person would be a fiduciary over those products. So you have situations where an advisor might, put forth an annuity that isn't necessarily in the best interest of the client. Obviously it's frowned upon to do that, but it happens quite often. And more often than not, it's based on what products are giving, a good commission. Sometimes it can be 5 to 10% of the contract value. Let's say you have $100,000. I mean, that could be a $5,000 to $10,000 commission for an advisor. It's very enticing for them. They really, really like that. I mean, it's a one-time upfront, and that is not paid by the client, the individual. That is paid by the insurance company. The insurance company will pay that. And as long as the individual will stay in the annuity for the agreed upon amount of time, say 10 years, then, in that sense, they say, oh, there's no cost, right? The advisor might say, oh, it's not going to cost you anything. I get paid from, XYZ insurance company, right? And so because of that, it's an easy sale to say that you don't have to pay anything, that it's safe, it's guaranteed, it's a good commission. So I thought it'd be helpful for those of you listening to understand the background of, like, well, why are they pushed so much? Are they really? Because if you just go off of what you see, I mean, they're the best things out there. They're the best things that you can do. So many places are pushing them, or marketing them, or saying you need to do this in order to be safe. And it's just really not quite the case. It's just a very easy product for an advisor to sell, that they may not have to have the best interest of the client. Commissions are really high. The sales pitch is frankly really easy. So getting back to annuities, I'm going to break down the annuities really into 3 different types here. You have variable annuities, you have indexed annuities, and you have fixed annuities. So we'll start at the bottom with the fixed annuities. I probably should have reordered these, but fixed annuities are the simplest of the 3. And when we have worked with annuities, fixed is what we usually go with, just because they're easy, they're simple, they're predictable. They're like CDs. We usually have a little lower, depending on the interest rates out there. But basically what you do with those annuities is you'll go to an insurance company. It is a pure insurance product. There's no investment related things to it. They will say, hey, for example, a 5-year annuity, we had recently looked at one, 5-year annuity at about 5%. I think after all the fees and stuff, it was like 4.75% for 5 years, guaranteed. And so basically what you would do if you purchased that annuity is you'd give the money, in a lump sum to the annuity company, and they would give you 5%. They would credit to your annuity account 5%, or whatever the agreed upon rate was per year for the set amount of time. In this case, say 5 years. And then at the end of the 5 years, you get the amount you put in plus the amount that was credited to your account. Very simple, much like a CD. And those are typically ones that we would like more than others, right? There's not a lot of added things to it. It's a very simple, very simple annuity. The next one I'm going to go through is the variable annuity. This is the one that gets sold most often, higher fees. And basically how it works is it is a mixture of both an insurance and an investment account, but it leans on the investment. So what happens is you would give, say you contact, we're going to go ABC Insurance Company. And you say, I want to buy a variable annuity. I have $100,000 that I'd like to purchase this variable annuity with. Okay, great. You give them your 100,000, then they will take that, open up an account for you, and then hire an advisor, an investment manager to come in and invest that money to get the highest returns that they can. And so because of that, you have higher fees, right? The insurance company needs to make money. They're paying an investment manager. They need to make money. They may have account fees or transaction fees, things like that. All of that before the return gets back to you. So there's a lot of hands in the pot that are taking a little bit here, a little bit there. On average, it could be up to 2 to 3% all in fees, with all these parties put together. And then you have the investment costs themselves, right? What are they investing in, the costs for those, say, funds or whatever it may be. So a lot of fees in there. And so they can be a little murky. Some of them can be clean, but not always. And so you're basically hiring an investment manager to manage your money. Now, on your end, what does that look like, right? Because otherwise, why wouldn't you just go give your money to, just say, John Doe financial advisor, right? Well, what the insurance company is saying, and they will usually on a variable annuity set a floor and a ceiling. And so, for example, and you're obviously invested. So let's say that the ceiling is 6%. So, but the floor is 0. So they'd say, hey, you're never going to lose money. We'll cap you out at 6%, but you'll never, if the market goes negative, you're at 0. They're taking it. The insurance company is taking the risk on the downside. But on the flip side, on the up, they also get the reward because they're taking that risk. They're taking that risk from the individual, from the client, and they're taking that on, which is great. You may love the idea of never ever losing money, and you're okay with whatever the ceiling, if it's 6 or 8 or 10. But for example, this year is a perfect example. It's a pretty crazy year, and most people don't really know exactly, at least at the beginning of the year, it felt very uncertain. You have the tariffs, you have all these different things, and those would be a time when somebody's, I really wish I had some protection here. But we look back at it right now, and a moderate portfolio as of the end of last quarter is getting 12.2%. So if you were in an annuity like this, you're missing out on 6, say that same 6 and 0, you'd be missing out on 6% of growth, and that would go to the insurance company. And there's nothing wrong with that, especially if you agree upon that and you're okay with that. But it is important to know how those work as you go into, you don't want to be caught in a situation where you have a ceiling that's too low and they're, the market's getting 20% and you're only getting 3. Those can be times that are difficult. We've seen that before, and it's not ideal. So really, that's how variable annuities work. Index annuities are similar to variable, but they're simpler, lower fees because they're tied to an index fund. They're not actively managed, so they're not going out and hiring an investment manager. They're just tying it to an index, but idea of capped upside, no downside, or very limited downside. And you usually will get more upside if you take on a little bit more. So if you say the floor is at -2, then you might get up to 10 or something like that. So those are the types of annuities, and when they would make sense, it just depends on what you're looking for. Again, most of the time with these annuities sell to, they speak to people who are inherently nervous about the market. They want some guarantees. They want some comfort there when it comes to investing. Let me just pop over and see if there are any questions. I don't think so. Oh, so yep. I don't think we have any questions here. So what are the red flags? If you have the opportunity to listen to a pitch for an annuity, or if you are, you have somebody that's looking at it, or you're looking at whatever that looks like, right? What are some of the things to look out for? So Number one, liquidity sacrifice. That's the number one thing there. Most of the time with these annuities, you're going to have long lockups, 7 to 10 years. I mean, it could be 5 on a fixed annuity, but especially on variable annuities, the insurance company likes to play the long game on it, because in the long run, they will, it works out for them. There, with the liquidity sacrifice, there are steep surrender charges. So if you need access to your money more than just say let's say they give you 10% of the value a year, 5% that you can pull out without no penalties. Let's say you need more than that for whatever reason. I mean, there are some steep charges. For example, we had talked to somebody that had, I think it was about 150,000 in an annuity that he had bought a few years ago. It was a 10-year variable annuity, and he was just capped. I think he was capped out at 3, -1. So he was just, and then after fees, really only making about 2% a year. And over the last few years, that's been, I mean, it's just not growing very much. So he was looking at busting out of it. And we were looking, I think he was 4 years into a 10-year. He had 6 years left. And even almost halfway through, as he gets closer to 10 years, those surrender charges come down. But even after 4 years, I think his costs to bust out would have been $25,000 of just pure cost that he'd have to walk away from in that value in order to get out of it. And for him, he would end up still in the negative, right? He was going to walk away with less than he even put in. So that's a red flag. There's something to look out for. Another one is, kind of just these costs when they're selling the no cost. A lot of times like, oh, this isn't going to cost you anything. It's just not true. It's just built in a different way. So always asking, what are the fees? What are you getting paid? How are you getting paid? Asking those kind of questions are a big thing to help you kind of see clearly what the costs of the annuity. You don't want to get stuck into an annuity that's expensive, that's pulling down on your returns that are already capped, because you might already have a cap, then you have fees pulling in, and you're just really having a hard time making it make sense in the market. It's often that people hear from advisors or get mailers once they hit 59 and a half, because all of a sudden, for the first time, their 401k is available. And sometimes they say, okay, you're 59 and a half, you're 60 years old. Let's put that money into a 10-year annuity, get you to get some money here. Let's grow it, safe growth for the next 10 years. And then you're really not going to need this until you're near 70 anyways. That's kind of the pitch, right? Like, roll this over. Let's roll it over into an annuity. It just can put people in a hard spot. One, like I said, when you have these costs that are pulling down on returns, and we're going to look at an example here in a moment, that can be, difficult for people, to have that rollover advice, because you're going to be pulling down on returns during those 10 years. But then also, again, liquidity. What if you find out that you can retire early? You're like, hey, I want to retire at 65. Well, I can't really get to my money or get to the income that I need from my portfolio. So going into looking at an annuity, make sure that it works with your timeline is the point that I'm making. And then, again, like I mentioned, advisor conflict. Sometimes people are selling the highest returning commission over, what might be the best product. So when you're talking to an individual or talking to an advisor, I think, making sure that there are multiple vendors that they're looking at and they're offering. That's an easy way to spot a red flag. If they're putting forth just one single vendor, it's hard to say that is the absolute best situation for an individual if they're just putting forth one vendor. So asking, it's like, hey, can I get call it a price check or a comparison with other companies that are doing similar, annuities, just to kind of, look at those prices and the returns and what they're guaranteeing, things like that. And if an advisor is a fiduciary, should have no problem, right? They got to do what's in your best interest. Let's run those reports. If they're hesitant to, no, we're really looking at this product, I would be hesitant. I would be wary of that, of that annuity, of that advisor, of what they're offering, if they're not willing to look at other alternatives for you to make sure that they're finding the best thing for you as an individual. We can we're running, coming into 10 minutes left here. I mean, we've kind of talked about this. Why does it work for them? Is that, they promise you 6 and then they get 8 to 10% or 12% or whatever the market gives them. The 10-year lockup ensures profitability over the long run. and we say this all the time to clients that we're working with, over the long run, when you're saving, 10 plus years for some of this money, the stock market, the market and investing, it works in your behavior, keeps up with inflation, all those different things. And in this case, it works out in the insurers and the insurance companies benefit. Yeah, client sacrifices liquidity. You get, a little lower than market returns. But again, on the upside, you might get a little better if the market goes down. So I wanted to bring up here, this is the reality for those of you that, may not know historically. And, all of this is over the last 50 years. So the S&P 500 and what would be considered the broad stock market, right, average about 10% a year over the last 50 years is what we're looking at. Obviously, some years more, some less. It goes up and down, but the average is about 10% a year if you're invested in the S&P 500. For bonds, about 5 to 6%, and I think cash is a little lower than that, maybe 3 to 4%. And the numbers is that if you have a moderately invested portfolio, 60-40, meaning 60% stocks, 40% bonds, so 60% in that 10% category, 40% of the portfolio is in the bonds and cash, so maybe call it 5% there, that will outperform annuities 2 to 3% a year. And really, it's just the fees, right? Because you look at that 2 to 3% as reference to the average fees for a variable annuity are about 2 to 3%. And that's the difference, is that if you go and do your portfolio, you're going to get on average 2 to 3% better than an annuity would. But again, not the only factor. Returns are not the only thing that are important here. It might be comfort, peace of mind that you might be going. And we'll look at just after this. So what I'm excited to look at is that variable annuity fees can reduce your wealth by 25% plus over 30 years. Now we're going to go over an example here. So both investors start with an investment of $100,000 and invest for 30 years in a 401k. We're going to in a retirement environment in this case. And this is the impact of variable annuities fees, right? So investor A, 100,000, just puts it in a mutual fund with a 50 basis points or 0.5% fee. That is very common, just active, run-of-the-mill mutual fund, okay? Versus investor B invests in a variable annuity that wraps the same mutual fund. So we're going apples to apples here, same mutual fund, but with a 2.5% fee. So we're going to kind of go into that, 2%. We're going on the low end of that variable annuity fee. If you have a higher, closer to 3, this would be even worse, but we'll say 2%. 2%, 50.5% for the actual mutual fund comes out to 2.5% fee. So putting in 100,000, you invest it for 30 years in that same mutual fund in both cases. Investor A is going to walk away with a final balance of $661,000 over 30 years, whereas investor B, if they left it in a variable annuity with those fees for that same amount of time, is only going to have 374. I mean, 200 and almost 300,000 difference in balances by somebody opening up an account, or an IRA or a 401k, and just putting it in a mutual fund, versus somebody that's like, I'm going to go an annuity and I'm going to put, you have some fee there and the exact same, exact same mutual fund there. So big difference. Those fees can really pull down over time, and especially when you have a longer term for some of these, some of these investments. So this is, obviously an exaggerated example of 30 years. You may only have a variable annuity for 10 years, but still, that it's not an insignificant difference between those two. Yeah, we kind of talked about these. This is just some functional things for every individual of what to do. Ask, are you a fiduciary? First and foremost, that should be the first thing to do. Ask an advisor. If the answer isn't yes, right away, walk away. Go find somebody else to talk to. If, on this and that, no, the answer should be yes. Say if you came to me or to Ben and say, are you a fiduciary? Yes, we are. And most, reputable financial advisors would be the same. Most, if not all, will be the same way. The second would be request total fee transparency. Ask about the fees. There's nothing bad about asking how in this case, challenge the no cost framing. Ask about the commission. Ask what they're getting paid. Why are they doing it? Ask those questions. And then the last thing is benchmark them against the 401k. And what I mean by that is, look at your 401k and see how it's doing historically. if you've historically been getting 10%, then be skeptical of something that's going to promise you 8%. Well, you've been getting X amount. Now, if you're underperforming in your 401k or IRA, looking at that, but benchmark it against average 401k returns, your own 401k returns, your own IRA returns. How are they doing? And more often than not, you're going to come out better in those environments than you would with some of these annuities, right? Yeah, I mean, this is we're kind of a little bit of redundancy here, but insurance companies design them annuities to win long term, but who should bear the risk? If you have a long time horizon, you're going to be better off doing it on your own. You should bear the risk in those cases, right? Because the longer the term is, the more in favor it is for the insurance company, right? Again, like I've said before, annuities make sense if you want certainty. You don't care as much about growth. You want stability. You want certainty. You don't want the risk at all. That would be a time to go with some form of an annuity. Yeah, well, I do know we have a couple of minutes here. I don't see any questions, but if the bottom line, I think with this is, if you have questions about, or if you are, evaluating an annuity, feel free to utilize us as a resource for you. We're happy to review them, to take a look at what you have, and to make sure that it is in your best interest. Because it isn't always, and that's one of the beauties of working with us, either individually or through a 401k, is that we're happy to take a look at those. For the most part, we don't do very many annuities. We have recommended them a couple of times over the years. But more often than not, when you look at the numbers, when you look at the fees, when you look at everything else, it just doesn't play out in the best interest of the client. And most people would be better off just putting that money either in an IRA or into their 401k, investing through mutual funds, getting that diversification, and really, just letting it sit and letting the market do its thing. Because at the root of it, that's what the insurance company is doing and hoping for. They're putting the money into the market and letting it do its thing over time. And there's a reason that they do it at such high volume, because it really does work out for them over the long haul. In a short time period, if this is money, now I will say that this is most suitable for money with a long time horizon, in retirement accounts, retirement savings, things like that. That's what we're talking about here. If you're looking at emergency savings or money that you're saving for a house, in the next couple of years, or for college or something like that, keep that away from an annuity. That's not what that's meant for. Again, annuity is for the longer term. You're gonna be penalized. It's gonna be really hard to bust out should you need it. If that money is meant for a short term, liquidity is key and most important there. So I just want to say that as we talk through these different types, of investment vehicles and things like that. But as always, if you have a question, give us a call our office, shoot me an email, shoot Ben an email. We're happy to talk through any of these things in more depth. I know we just have 30 minutes here, so it's kind of hard to go in depth on some of these things. We're happy to have those conversations, set up a time to talk, or to talk specifically about a situation of yours. Maybe you've run into things, or maybe your parents or your aunts, your uncles, your kids, your whatever that might look like, are running into these scenarios. Happen to run into annuities and saying, hey, what's the deal with this? We'd be happy to have those conversations and help to explain the annuity and make sure that it's in the best interest of an individual, because that's what we love to do. So anyways, well, thank you. We're coming up, 1 minute left until the end of our 30 minutes here. Thank you, everybody, for taking a few minutes out of your day to listen to me ramble on about annuities. I don't. If there are any takeaways out of here, the idea from the first slide that we popped on is that it's not about it being good or bad, right? It's about seeing it clearly. So with annuities, as anything else, it's all about understanding what you're getting into, because it doesn't necessarily mean that it's bad. But what happens, the bad situations or the difficult times, are when somebody gets into something that they didn't fully understand. That's where we run into issues. That's where we hear the horror stories of annuities. And so going in eyes wide open, and really, understanding what fees, what it looks like, what the structure is, and then making the decision of if we would want to move forward with that. That's the goal. That's what we hope for, and that's what we want to support from an education standpoint. So anyways, it's 10:30 now. Thank you so much for joining us on this webinar today, and we look forward to talking next month in November. I believe the topic next month will be, I believe it's going to be professional development and entrepreneurship, but we'll make sure to send out a notification beforehand of that topic for everybody, so that you can be ready and hop on if that is of interest to you. So anyways, happy Thursday. Enjoy the rest of your week. Enjoy the fall weather. It's been beautiful, and we'll talk soon. Thank you.